FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex Trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well-capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 4/15/19, otherwise known as Tax Day, that day you've been waiting all year for. Hardly wait. It's just a pleasure to get up in the morning and send out that check to Uncle Sam. It's got to make you feel warm and fuzzy and good all over. Well, maybe not. Anyways, we got some economic storm clouds on the horizon. We've got some trends going on overseas in Germany, in China, and we've got Trump versus the Fed and who's going to win that one. Well, with us to help explore this, we've got Craig Hemke, and you find him at tfmetalsreport.com, and our old steady John Rubino from dollarcollapse.com. So, gentlemen, welcome. John.
Morning, guys.
Kerry, the only warm fuzzy I get is the lovely tones of your voice.
Well, hey, I'm flattered, of course. So, hey, but when we're looking here, hey, it's kind of like, just like Christmas comes once a year and New Year's and all these other holidays, Tax Day. Well, Tax Day really is every day of the year. You just get to pay it certain days. But for the first, 6 months of the year, 5.5 months, you're basically working for Uncle Sam and whomever your local kleptocrats might be in your chosen state, city, and county. And you're paying them for your water, you name it, your sewage removal, anything they can nick you for, they're doing it. But so that's all well and good. That's been the system here for a long time, and it keeps getting worse post-World War II. This is what's been going on. But then we have newcomers on the way who don't really know the rules of the game yet, are trying to rewrite their own rules, and at the same time falling into the mistakes of the U.S. So, John, I mean, we got recently you wrote about China back up, foot on the accelerator, pedal to the metal, debt creation. And I mean, it's an unsustainable level that they're going towards here, isn't it?
Hey, Kerry. Yeah. There's a pattern forming out there where after a lot of really aggressive borrowing and money creation, that some of the big countries in the world tried to scale it back a bit. And each in their own way has failed miserably. It just didn't work. You can't create this much debt and then try to tighten monetary policy. That's what we're finding out. China is a great example and a really current example because they basically quintupled their debt between 2008 and 2016 or so. And that's one of the big things that pulled the global economy out of the Great Recession. In the process, it gave them a lot of bad debt that started to flake out on them. They had all these local governments that built entire cities or new airports and roads and bridges that didn't work out, didn't generate enough cash to pay off the debt. So you have a local debt crisis in China. And so they tried to tighten a little bit to stop the increase in debt, and it didn't work. Their economy started to slow down dramatically. Their stock market got really volatile. And so now they're back to aggressively easing again. And their total debt in the system is growing at about 13% a year right now, which is twice the official growth rate of the economy, which is probably inflated. So it might be 3 times the real growth of the economy right now, which means debt to GDP is soaring in China. And this is 10 years into an expansion when normally countries are running surpluses or at least very small deficits because everybody's at work and they're all paying taxes. And something similar is happening around the world where Germany now is seeing its economy slow down, even though it never did increase interest rates. So it's under pressure to run bigger deficits and start cutting interest rates again. In the US, we tightened for a little while, and our economy and our stock market in particular got really unstable. So the Fed has now decided it's not going to tighten anymore, and President Trump is publicly telling the Fed they need to cut interest rates. And he's trying to name people to the Federal Reserve Board who are or would be aggressive interest rate cutters if they get a chance to vote on it. So the whole world basically has gone from at least talking about tightening and maybe tightening just a little bit to easing aggressively. And you can't overstress the difference that we're seeing this time, because normally central banks wait until there's trouble to ease. There's a recession and then they start cutting interest rates dramatically. This time, no, we're still in a recovery. We're still in an expansion, and we're preemptively loosening monetary policy and fiscal policy now. So this is different in a very scary way.
Yeah, we're in a whole different realm here, a whole different mindset. And Craig, what's your thoughts here? I mean, how much longer can this daisy chain of debt go on? Can it just keep going and going, and everybody is just fat, dumb, and happy?
Yeah, Kerry, before I get to that, I want to go back to what you mentioned, that it's tax day, and just I guess use this occasion to point a few things out to folks that they may think it's coincidence, but maybe not. The 16th Amendment institutionalizing the federal income tax was passed in 1913, the same year that the Federal Reserve came into being. Coincidence? No, of course not. No. It's kind of like COMEX gold futures were first instituted on December 31st, 1974, one day before U.S. citizens were once again allowed to own physical gold on January 1, 1975. Coincidence? No, of course not. So there are a number of these things that kind of come together. And as you mentioned, debt, and as John discussed, debt to GDP, those are all Keynesian principles. That you can just grow and issue more debt, and cash, of course, in its current state is a form of debt. And we're at that kind of end game where the amount of debt created is just equating to lesser and lesser growth. China's seeing that, as John mentioned. And it gets this kind of this out of control creation of the currency to try to service the existing debt. We brushed up against that level of interest rate that made it impossible back in, I guess we'll call it the third and fourth quarter of last year. The 10-year note got to 3.25%, and that was as far as it would go. The stock market in the U.S. began to crash. Global equity markets went down with it. And then all of a sudden, we went from everybody from like Jan Hatzius, the chief economist at Goldman Sachs, was talking about 4 more rate hikes in 2019 as recently as November last year.
Correct.
Well, you and I, John, everybody else were saying, no way, not a chance, not a chance. And that's all being proven correct. And you got to give this, though, some time. We're not into just an immediate collapse like we saw in 2008, but we're definitely trending that way. And I guess, if anything, the one indicator that I think everyone should watch that telling you right now that there are no rate hikes coming, in fact, there are rate cuts, is the bond market. I mean, the yield on the 2-year note is 2.39%. Well, the effective rate of federal funds is 2.4%. The yield on the 10-year note is about 15, 16 basis points higher, up at 2.55. Well, if the Fed were to hike 25 basis points and put an effective rate on the Fed funds rate up to 2.65, you'd be fully inverted out to 10 years. They're not. They're not. It's all folly for all the pundits on CNBC to talk about it even being a possibility. It's not going to happen. And then on top of that, as you guys mentioned, you've got Larry Kudlow, who is Trump's chief economic advisor. You got the 2 cats he wants to put on the Federal Reserve Board of Governors, Herman Cain, and of course Stephen Moore, all saying we need a 50 basis point rate cut, which is what the bond market's telling you as well. This is where we're headed. It's not fully reflected yet in precious metals prices, just as QE2 was not reflected in precious metals prices during the spring of 2010. Once the world wakes up to that, things are going to get interesting, regardless of how things look here on April 15th.
Yeah.
So what this means is, guys, that we can never raise interest rates again. It sounds like the markets have spoken. We have so much debt in the system that if you raise interest rates, everybody's interest costs go up, and that tanks whatever economy is seeing those higher interest rates. So that's it. We are in a new phase of the fractional reserve banking fiat currency era, in which interest rates are where they are now or lower, and that's it. They can never go beyond this level, and that's a really big deal. You know, a lot of people didn't think it was going to be that way. They were talking about normalizing interest rates.
Right.
Yeah, that was the buzzword.
Yeah, for years.
Yeah.
And they're being revealed now, finally, for those willing to see. They're being revealed, in the whole emperor has no clothes. They've told us now, since 2010, that interest rates are going to normalize, a balance sheet was going to normalize. And now they just told us 3-4 weeks ago that they're going to stop the quantitative tightening with a balance sheet of $3.7 trillion. That's, what was it, 1.1 trillion when this all began? Mm-hmm. So the new normal is that. It's not, back to whatever everybody said it used to be. And again, they're being revealed now for not really having a plan. This is all, this big massive experiment they've been running since 2008. And again, as that slowly sinks in to asset managers, institutions, regular investors, all of that augurs, in favor of gold and silver.
Yeah, I'm inclined to agree with you. It's just all the timing. We don't know. Along those lines, where you were talking about Stephen Moore and Herman Cain, it looks like Herman Cain is probably not going, the nomination's going to get withdrawn, but Stephen Moore is surely going to be put on the Fed, which is kind of interesting because I always see the guy at libertarian conferences, and yet here he is literally marching into the belly of the beast. Craig, is this for show, or what does it really mean?
Isn't that funny? That's where I met you the first time, Kerry. Was at Freedom Fest.
Yeah, that's right. Yeah.
Whatever that was. And that's where I met Stephen Moore for the first time.
5 years ago, right? Yeah.
Something like that. Yeah.
6 years ago.
I don't know what to make of it. I really don't. How much power a Stephen Moore can have. And I was out all of last week, so I didn't know about the Herman Cain thing. But clearly, Trump is, if it's not him, it's somebody else that is more in favor of loose monetary policy, if you want to call it that.
What president wouldn't be, right? What president wouldn't be in favor of loose monetary policy?
What politician? Right, exactly.
Yeah, exactly. There's nothing to be gained by keeping inflation low. It's only when inflation gets out of hand, that's when all of a sudden, we got to do something about this inflation. And so it's really an impossible situation because every political instinct says just inflate your problems away, right?
Correct.
Well, we've got an easy money consensus forming now across the political spectrum because on the left, obviously, they always want low interest rates and easy monetary policy. But now the modern monetary theory has become the monetary ideology of a lot of people in Congress, where it used to be a fringe theory, which said that governments don't need to tax and borrow. They can just print as much money as they need to run themselves. So just skip the whole capital markets IRS thing and just let the Fed finance the economy. That used to be seen as a really extreme idea, and now it is mainstream on the left of the Democrat Party. But over where you would expect the opposite to be true, on the right of the Republican Party, you've got the president now naming people who want to cut interest rates dramatically from here to the Fed. So there's a consensus for lower interest rates out there. And it almost doesn't matter who's in charge now to what's happening in the future of monetary policy, because whoever is in charge is going to not just keep rates where they are now, but cut them in coming years. So I think that's the next big thing that everybody's waiting for. At first, we were waiting for the Fed to stop raising interest rates. And now the next big thing is their first cut. And it looks like there's a pretty good chance that that comes before year end, that we're going to see rates start to head back down while the economy is still growing. And this is really uncharted territory. It's hard to know what to make of this because we've never tried an experiment like this before. But yeah, Craig, what you were saying about this being good for gold, that makes a lot of sense because one of the problems with gold and silver is that they don't pay interest. So they're competing with interest-bearing financial assets like government bonds. But if we're going to lower interest rates to zero and beyond into negative territory, which it looks like we're going to do at some point in the U.S. and which is already the case in a lot of the rest of the world, then gold and silver, which maybe cost up 1% a year to store, look just fine from a cash flow standpoint compared to government bonds if they also cost you 1% a year to own. And there's no comparison beyond that in stability. So if you've got a choice between a government bond yielding negative 1% and gold and silver yielding negative 1% in terms of cash flow, you want the stable money. So you would think that a lot of money would flow into precious metals in the kind of environment that we're creating for ourselves out there.
Well, interesting times for sure. And nobody seems to have the answers out there. But Craig, how likely is it that in the next, when I interviewed you last time, you said you expected the Fed to be cutting rates by September. And that's probably going to be pretty close. Good chance of it in any event. But how far off is the next disaster? Can they keep the house of cards from falling over, at least till the next president comes in? That's the name of the game, right? Kick the can.
Yeah. First and foremost, Kerry, they probably can keep it going longer than we expect, even at this late hour, right? I didn't think they'd make it out of 2011. And here we are in 2019. And I would just keep drawing back to, again, as we've been discussing several times already this year, Kerry, just the idea that this year, 2019, looks and smells a lot like 2010. And that you were coming out of the crisis in 2009 into 2010, and we were all fed this line. Again, beginning then, really, of normalization, and the Fed had it all under control. And the QE that was first rolled out in March of 2009 was a one-off. It was just a one-time deal, right. $600 billion and all that kind of jazz. And the U.S. economy was responding. There was all this talk about green shoots. That was the big, word back then, big phrase. And by the second quarter of 2010, GDP was measured at 3.2%. Man, everything looked great. Gold and silver were going sideways the first half of that year, around $1,200 for gold and around $16 for silver. And everybody thought, okay, everything's under control. Well, then everything started to roll over and contract by the third quarter. And by the fourth quarter, we were almost into negative GDP. And in November of that year was when QE2 was announced. And that led to a crisis of confidence, not only in the Fed, but that extended into the U.S. political realm. We had debt ceiling problems, which are also pending at present. The political discord. S&P downgraded U.S. debt for the first time in August of 2011. And all these things combined to send the precious metals soaring. So we can sit here in April and, lament that we've been pushed back from the earlier highs that we saw back in February. But that doesn't mean we're not on track to kind of follow the way we did in 2010. Yeah, I'd be very surprised if, as John said, we're not at least one rate cut this year. Look, if the stock market were to roll over in any fashion, you could get one in June.
Yeah.
It may take a little longer than that. And like we said, these things always seem to take a little longer than expected. But that's definitely, it's almost not arguable that that's where this is all headed. It's just the timing that people need to be wary of. And so thus, you just have to use this time to your advantage. They always talk about things being on sale. Well, okay, whatever you want to look at it. But the math of all this is pretty much a certainty. And people need to take the time to understand that, educate themselves, and as we say, prepare accordingly.
Yeah. What's your thoughts, John?
Well, yeah, the next disaster is really the big thing that we got to be looking for here, because we will drift in a generally negative direction with interest rates at this level, but it doesn't look like we're going to fall apart or anything. So something has to happen. And it could be an equities bear market. Stocks are priced for perfection right now, and earnings this year are going to be disappointing, in part because some parts of the economy are slowing down, and in part because 2018 was a really good year for corporate earnings. So it's a tough comparison. So in the stock market, the question is, can you have rising equity prices with falling year-over-year corporate earnings? And normally that's not how it works. This is an unusual time in so many ways that this might just be one more thing that doesn't normally happening. But generally, if companies are going to report earnings disappointments, that impacts their stock prices. So if the equity markets start to roll over, that would do it. That would be enough. The Fed and the government, to the extent that those two things are in any way separate right now, know that an equities bear market, in other words, a 20% drop in the average stock price, might be enough to push us over the cliff. Because when the wealth effect, in other words, the fact that if your stocks are up, you spend more, and if your stocks are down, you spend less, that could tip the economy into a recession if stocks go down. And a recession, with all the bad debt that's out there, could turn into something worse than 2008, 2009. They know all this, and they don't want it to happen. So let stocks start to behave in the future like they did in October, November, and December of 2018. And that creates the conditions for really aggressive easing. In other words, the Fed coming in and giving Trump the 0.5 point cut that he wants, with more promised in the future.
Yeah.
Or the federal government ramping up deficit spending, doing that infrastructure plan that they've been talking about for such a long time. And the federal deficit going to 1.5 or $2 trillion a year. Those are the kind of things that can change the nature of the system, because there's a limit to what we can do, and we haven't found that limit yet. But we're going to get closer if we push interest rates back down to zero and we start running $2 trillion a year deficits. It's possible that that's the end of the system. It's possible that we can't do any more than that. So that end is out there. That wall we're going to hit is out there, and we just have to find out where it is. And these guys are they're doing things that are pretty much guaranteed to take us in that direction at an accelerating rate. Interesting times from a theoretical standpoint. Terrifying times from a normal person trying to live their lives standpoint.
And as John said, Kerry, they have to keep rates low for debt service for not only the government but institutions, private companies, public companies, individuals, whatever. They got to keep interest rates low for service of the accumulated debt. But that is so now distorted and unnatural. And with all the additional money that's been created over the last 10 years, sloshing around the planet looking for yield, rates are at historically low levels. We have over $10 trillion in global debt that's yielding a negative rate. So not only is it the individual that is, can't stomach a 25% or 50% drop in the stock market for what it would do to their 401k and their IRA and all that kind of stuff. It's also these institutions, the insurance companies, the pension funds that for decades have relied upon the bond market and interest rates for safe, steady, 5, 6, 7% returns, that they're now all have grasped for anything to provide a positive return. Kerry, didn't I just see something over the weekend? It was Canada or somebody that has approved pension funds to buy crypto.
Oh, I didn't hear about that. Interesting.
I mean, this is just emblematic of the desire of these, all of these institutions to somehow eke out a positive return. They're all shorting the VIX. They're all, all this stuff, and they cannot afford a collapse in equities. The Fed knows this. This is all part of the scheme and the scam. And that's why they will do everything to keep it afloat, which, as John just eloquently stated, will include cutting interest rates. Mario Draghi said that just last week too, right? Said we'll do anything. We'll do everything. I mean, it's 10 years later. This is supposed to all be fixed. We'll do anything.
What happened?
In the toolbox.
Yeah, what happened? It was all supposed to be fixed, never to happen again. Things like Dodd-Frank and other so-called reforms, which were anti-reforms effectively. For some reason, we just can't allow the market to take care of this stuff, or at least close out the banks, start new ones, and put the old ones into receivership. Never could be done. And now they're way bigger than ever. They're really too gargantuan to fail. So if I had to ask you, John, we're looking next tax day to 2020. What do you think is the situation?
Well, it's possible that a big part of the story a year from now will be the pension fund. As Craig mentioned already, they're in really bad shape at the end of a long bear market or bull market in equities. In other words, they should be in great shape right now because a lot of their assets have gone up in value, but they are so badly managed. Wall Street preys on pension funds. They suck huge fees out of the investments that they sell to pension funds without generating the kind of returns that pension funds need. So with, for instance, Illinois and Chicago having insanely underfunded pension funds and an equities bear market, let's say, happening during the year, that would make those funds even more underfunded. And it would force those entities, Chicago and Illinois, to pay way up to borrow, which they are doing now. They're borrowing huge amounts of money. And that could be the catalyst for the next financial crisis when people figure out that Chicago is literally bankrupt and everybody starts dumping muni bonds because nobody wants to be exposed to the next Chicago. I think that's a really good possibility as the thing that is front page news a year from now, and that is leading to the dissolution of this system. The whole fractional reserve banking fiat currency world is coming to an end pretty soon. These things don't work. And once one big part of the fiat currency world stops working, people are going to figure out that it's not that one thing, it's the whole concept. And so that's what's coming. And whether it happens by this time next year or whether it takes a lot longer, we're still headed that way. So, it's fun to talk about what could be the catalyst for the big financial crisis, but there are just so many things out there because the overall system is what's broken. And that's led to a lot of mini bubbles and failed states and other entities, any one of which could be the thing that brings down the whole system. So, there's so many moving parts that it's impossible to make any kind of prediction with any specificity. But you know that crazy times are coming just because so many bad things could happen, and the odds of any one of them happening might be small, but the odds of something bad happening, they've become more of a probability than a possibility now. So crazy year coming.
Yeah, I think it's going to be crazier. Maybe the collapse won't have come, but the untenability of the situation will become more and more apparent, especially, as John said, with potential state and municipal insolvencies. Clearly, Chicago is insolvent. Clearly, the state of Illinois is insolvent. The state of Kentucky is insolvent, and a number of others. Really, for all intents and purposes, California is insolvent. New York, not so much. Connecticut, yeah. New Jersey, yeah. So we got big problems coming on the horizon, or as I would entitle this episode, there is no light at the end of the tunnel.
Good.
Yeah, that works for me.
All right.
And the only final thing I would add, Kerry, is if you look, a lot of folks are frustrated. They look at the dollar price of gold as traded on the COMEX and use that as their barometer. Well, okay, if you're a holder of dollars, if that's your primary currency, sure. If you look around the planet, whether it's Canadian dollars or Australian dollars or Turkish lira, you go wherever you want and you find gold making all-time highs in those other currencies. That's reflective of a loss of confidence in those currencies. And because we measure the dollar against all those other currencies, somehow that makes the dollar look stronger, right? The euro's been going down, that makes the dollar index go up. And it's essentially the cleanest shirt in the laundry, or whatever you want to call it. It will again soon be the dollar's turn in the barrel, as it was, in 2010, 11, and 12. John's great site, dollarcollapse.com. I mean, that's where this is headed. Again, there will be a loss of confidence in the Fed, in the ability of the U.S. Institutions to manage the Fed, right? Or them working together, however you want to put it. leads to a loss of confidence in the dollar, and it will be the dollar's turn the barrel again, and it will be the dollar price of the precious metals that will again be working to new all-time highs.
Inclined to agree.
Just keep that perspective in mind, as we plod through this year. I mean, this is all eventually coming again. It's a cycle, and people just need to keep their eyes on the ball.
Okay, one last word from John, and then we'll call it a day.
Okay. All this gloom and doomy stuff can be very depressing to hear and to think about, and definitely to focus on. But we should keep in mind that this is really an investment thesis. The bad stuff happening in the world isn't the story. It's what goes up when all that bad stuff happens and how we can profit from it. So precious metals obviously work in times like this. Other kinds of real assets will tend to do pretty well too. And the gold and silver mining stocks ought to just be rockets when all of this stuff starts to play out. So we shouldn't think about this stuff and spend too much time on the dark part of it, because there is a lot of darkness in the trajectory of the global financial system. But there's also a lot of opportunity. In times of big crises, most people do badly and a handful of people do really well. So we should be trying to figure out how to be the people who do really well and use the capital that we create by being right about this to protect our friends and our family from the stuff that's coming. So this doesn't have to be depressing. It can be really exciting and optimistic and basically a good thing, at least for you and your family, if you do it right. And that's what we should be trying to do.
And let's hope that you are correct. Well, it'd be better if none of this was going to happen, but I think that the wheels have been set in motion. There's no turning it back. It's going to happen. In any event, make sure you go take a look at Craig Hemke's site, tfmetals.report.com, John's site, which is dollarcollapse.com, our site, financialsurvivalnetwork.com. Sign up for all our newsletters. You can't get enough information. This could be a major opportunity or crisis for the not too distant future. So being prepared, understanding what's happening, making your own decisions is definitely the way to go. Hey, John, thanks so much for joining us.
Thanks, Gary. Thanks, Craig.
And Craig, we really appreciate you coming by, as always.
Hey, my pleasure, guys.
All right, guys, thanks so much. And we'll talk to you guys again soon in the next month or two, see how this thing unfolds.
Okay.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.